let me return for a moment to the issue of Libor. Can you give us and the millions of Americans that depend upon Libor, because it tells them how much they have to pay for their car loan or their student loan, et cetera, that the current Libor is reliable, that the changes that were made or suggested by the New York Fed or others have been put in place, and that this is an index that is, in fact, reliable and not being subject to manipulation going forward?
I can't give that assurance with full confidence because the British Bankers Association did not adopt most of the suggestions that were made by the Federal Reserve Bank of New York. They made a relatively small number of changes. I think it's likely that the concerns are less now because we're no longer in the crisis period, and that, as I mentioned, was a period in which transactions at many maturities were not taking place. I would like to see additional reforms to the Libor process, assuming that Libor will continue to be a benchmark for financial contracts. Alternatively, there are a number of people looking at alternative benchmarks like repo rates or the overnight index swap rate or other types of interest rates, which have the advantage over Libor that they are market rates as opposed to simply reported rates.
What steps are you taking, though, given that concern you've expressed right now, not retrospectively how we got here and who did what to who, but to provide as much certainty as you can? There are several banking institutions you directly regulate that contribute to Libor. There is your relationship directly with the Bank of England. What are you doing, not just you personally, but the Federal Reserve, to ensure this index is appropriate? And again, I encourage you to study these alternatives, but the Libor is so deeply interwoven and embedded into thousands and thousands of contractual arrangements throughout the world that it's going to be hard to next week shift to something else.
Well, again, I think we are and need to continue advocating for reforms to the Libor process. It is constructed by a private organization in the UK, and so our direct ability to influence that is limited. With respect to the 3 banks in the United States which contribute to the Libor panel, 2 of those banks have reported in their SEC filings that they have been asked for information by investigating agencies. We are following that very carefully. We will see what happens, and we will provide any support and help we can to those investigators.
Let me turn to the more the monetary issue. And the Federal Reserve has been, in some cases, sort of pursuing aggressive monetary policy while fiscal policy has not kept up in some respects. And I presume you're prepared to continue to do that, given unemployment numbers, inflation numbers, et cetera. That's regardless of what we're doing on the fiscal end?
Our mandate tells us to do the best we can for employment and price stability, and we will continue to do that. Of course, we would appreciate other policymakers playing the appropriate roles themselves as well.
One of the comments that you made, and I'll give you a chance to amplify it, is that there will be a need, I think, in your view, and next year for continued stimulus, for want of a better term, if we are going to reduce unemployment, which is one of your mandates. And that if we reach a solution that is heavy on cuts to spending, that is heavy perhaps even on cuts to entitlements, that would not provide stimulus, in my view, and it could further impact unemployment in the country. Is that an accurate assessment? Well,
the position we've taken is, I would say, at a first cut, is do no harm. What we need is a strategy which addresses the long-run sustainability issues. We can't forget about that. At the same time, if the fiscal cliff is allowed to happen, it will certainly have major negative effects on the recovery. The CBO, the IMF, and many other observers have made similar recommendations, and we feel that's a reasonable balance between the short and long term.
But some of the specific issues that we face at the end of the year are filling a gap in the 2013 in terms of spending, in terms of revenues. And if that 2013, if we avoid the cliff by taking another route, but that route is significantly decreases spending, decreases other stimulative effects, would your view be that we could have avoided a cliff but still found ourselves in a very perilous economic situation because employment will continue to decline?
It's a question of the time frame. In the very near term, we already have a lot of fiscal drag coming from state and local governments, for example, as you know,
right,
and some coming from, inevitably, from the federal side. In no way am I saying that we shouldn't be making strong efforts to achieve long-term sustainability and make a credible plan as soon as possible for doing that. But it would be better to make that plan soon, but to have the effects come in more gradually to allow the recovery, the air it needs in the short term.
Thank you, Mr. Chairman.